President Mester, thank you for joining us.
Thanks a lot, Sarah, for having me.
So you just heard another really steep sell-off, an ugly day on Wall Street. Is this part of the plan to see tighter financial conditions?
Well, yes, but not necessarily all at once. So again, we're really committed at the Fed to get inflation under control, achieving our dual mandate goals of price stability and maximum employment. And as we've, many people have spoken to and the chair has spoken to, we are trying to let the markets know where we see the economy going and why monetary policy needs to move off of that really extraordinary levels of accommodation that was needed at the start of the pandemic. So we're in this sort of recalibration phase. You could think of it as a great recalibration of monetary policy from what was needed at the early stages of the pandemic and throughout the pandemic to support the economy, to now moving off of those emergency levels, removing accommodation because inflation needs to be brought under control. And of course, our goal is to do that in a way that sustains the expansion and sustains healthy labor markets.
Right, the whole soft landing idea. So as we've heard from more Fed speakers, including the conversation that I had yesterday with Fed Chair Jay Powell, the market has increasingly priced in more rate hikes and more aggressive action by you. There are now several 50 basis point rate hikes priced in starting in May. Is that right to you?
Well, they're reading the same economy, data and making their judgment and then taking what we've said at the Fed about what our intentions are. I do think we have to be resolute and intentional in bringing the Fed funds rate up to a level that's neither stimulative, where it is now, nor restrictive, what we call a neutral rate. And my own view is I'd like to get there by the end of the year. And my own estimate is around 2.5% for the neutral rate. And then that puts us in a really good position to look at what the effect of our changes in monetary policy have meant for the economy, as well as a lot of other factors that are really driving these high inflation readings. For example, the supply chain disruptions, war in Ukraine, which is terrible, but also adding an economic burden in terms of higher energy prices, higher commodity prices, higher food prices, the zero COVID policy in China, which is affecting supply chains. So there's other things other than monetary policy affecting the inflation rates. But we have to do our part with our policy tools to reduce some of the excess demand in the economy and bring demand into better sync with the constrained supply side. And that's what we're in the process of doing now.
What about a 75 basis point hike, which is something that's been mentioned lately? Is that something you'd consider?
Well, everything is always being, as we always say at the Fed, we consider everything. My own view is we don't need to go there at this point. And I'd rather be more deliberative and more intentional about what we're planning to do. And I see, being on the path we're on now, I would support at this point, given where the economy is, a 50 basis point rise in May and a few more to get to that 2.5%-ish level by the end of the year. And I think that's a better path. I mean, doing a one-off outsized move in the funds rate doesn't really appear to me to be the right way to go. I would rather be more deliberative and more, consistent in bringing up the funds rate and signaling that that's what the path we're on. And then when we get to that neutral rate, where policy goes after that is going to really depend on how that policy has affected the economy as well as these other factors. We know that fiscal policy is going to be waning this year, the effects of the pandemic results, but we don't know how that's going to look. And so let's be on this methodical rather than overly aggressive path, and then see how policy transmits to the economy and see how the economy evolves. Remember, it's always good to remember that monetary policy transmits to the economy via expectations and movements in financial markets. So that's why I kind of favor this methodical approach rather than, a shock of a 75 basis point. I don't think it's needed for what we're trying to do with our policy.